The world is watching China's currency closely. Recent reports suggest that Beijing may allow the yuan to weaken against the US dollar in 2025. This potential move is driven by a confluence of factors. China's economy is facing headwinds, growth has slowed, and the country is grappling with low inflation. Adding to these pressures are the persistent trade tensions with the United States. The re-election of Donald Trump with his penchant for tariffs has only heightened these concerns. A weaker yuan could make Chinese exports more competitive. This could provide a much-needed boost to the country's manufacturing sector. However, such a move is not without risks. A significant devaluation could trigger capital flight, as investors pull their money out of China in search of safer havens. This could further destabilize the Chinese economy and send shockwaves through global markets. China's economic planners are walking a tightrope. They must balance the need to support their economy with the potential risks of a currency devaluation. The decision of how and when to act will have far-reaching implications, not just for China, but for the global economy as a whole. As a weaker yuan would be felt far beyond China's borders. Emerging markets in particular are likely to be impacted. Many of these economies are heavily reliant on exports to China. A slowdown in Chinese demand brought on by a weaker currency could have a ripple effect throughout these countries. The United States, too, would feel the impact. A weaker yuan would make Chinese goods cheaper for American consumers. While this might seem beneficial in the short term, it could lead to job losses in the US manufacturing sector. Furthermore, it could exacerbate trade tensions between the two economic superpowers. The interconnectedness of the global economy means that any significant shift in one part of the world is bound to have repercussions elsewhere. A devaluation of the yuan would be no exception. Governments and businesses around the world are watching closely, bracing themselves for the potential fallout. In the face of these challenges, China is not standing still. The government has announced plans to increase economic support in 2025. This includes adopting a moderately loose monetary policy, essentially making it cheaper for businesses to borrow money. The government has also promised a more proactive fiscal policy, suggesting that it is prepared to increase spending to stimulate the economy. However, these measures may not be enough to offset the headwinds facing the Chinese economy. The country is grappling with a number of structural issues, including a massive debt overhang and a slowing property market. Addressing these challenges will require difficult reforms that may be politically unpopular. The People's Bank of China, the country's central bank, is also playing a key role in managing the yuan. The PBOC sets a daily reference rate for the currency, known as the fixing. The bank has been allowing the yuan to weaken gradually against the dollar in recent months. However, it has so far refrained from a sharp devaluation. The future of the yuan remains uncertain. Analysts are divided on how far and how fast the currency is likely to weaken. Some predict that the yuan could fall to as low as 7.5 against the dollar by the end of 2025. Others believe that the PBOC will intervene to prevent a sharp depreciation. What is clear is that the global economy is at a crossroads. The decisions made by policymakers in China and the United States in the coming months will have a profound impact on the trajectory of the global economy. The world is watching with bated breath.